When business owners ask, what's a reasonable salary? Well, that's a freaking loaded question. What's up, guys? Mike back at it again from Ledgerly, CPA, alongside my partner, Andrew D'Amico, also a CPA, going over the latest and greatest tax strategies for you as a hardworking business owner, individual, for you to implement into your life. So if you love these topics of keeping more money in your pocket than giving it to Uncle Sam, make sure you hit that subscribe button. Stay tuned for weekly videos just like this one. So reasonable compensation, it's a loaded topic, but let's zoom out for a second. When it comes to reasonable compensation, we are talking about shareholders, owners in an S corporation. And reasonable compensation is one of the most misunderstood rules in the S corporation world. But don't worry, we're going to break it down, try and make it as easy to understand for S corporation owners. So if you're an S corp owner, wanting to know how to pay yourself properly, the right way, and someone that wants to be proactive about your reasonable compensation throughout the year rather than scrambling in December, well, then this video is for you. So there are a ton of rules, guidelines, codification, articles, a lot of factors that play into reasonable compensation. Now, we're going to go over some of the things that are probably thrown at you, but today we're going to actually take a step back and go over how we have been taught reasonable compensation and how we teach it to our clients. So yes, there are a lot of factors that play into reasonable compensation. And some of those factors might be, hey, what's your role in the business? Well, if you're the shareholder, then you're the owner of the company. How many hours have you worked on the company? We all know we're business owners. We don't stop working. What's your level of decision making? What are the industry norms? What's the profitability of the business? What's your basis in the business? What's the compensation history, etc. But let's take a huge step back. You might have an S corporation with one employee, and that employee is you. Or you might have an S corporation with 100 plus employees. However, for the sake of this video, the sake of reasonable compensation, we are talking about you and only you, not your employees, because you can pay your employees what they're worth. But the beauty about reasonable compensation is we still get to pay you what you're worth, and we can avoid some of this FICA up here. What the FICA? We all hate FICA. So we are going to teach you how to be reasonable for yourself. So let's break it down. Let's break it simple. Now, let's say you have other employees. Let's say you have 10, 20, 30 other employees. You're going to pay them weekly, bi-weekly, 26 times a year, 24 times a year, 52 times a year, whatever. That's going to go through payroll. But for you, the way that you are paying yourself is going to be by distributions or owner's draw. Hey, time to pay myself. It's time for me to reach into my business bank account and take cash out, whether it's a check, whether it's a transfer to my personal account. I'm going to pay myself each month. Maybe it's $5,000 a month, $10,000 a month, whatever you need to live on, whatever you are taking personally to live on, that's what you are taking as a distribution. There's no payroll. It's simply an owner's draw. It's balance sheet. It's equity. So we're doing that on a weekly basis, monthly basis, quarterly basis, whatever it might be. Now, next step is every quarter, we are going to do a payroll allocation. And then after that, it's rinse and repeat. Back to the top. Distributions, quarterly payroll, rinse and repeat. So again, we are talking about you. You are the owner of this company. You are the sole owner of your S corporation. It might just be you as a single member LLC as elected S Corp status, or it might be you with 15 other employees. Take the other employees out of the picture. You pay them what they're worth. You pay their benefits, what their value is. We are talking about you, the owner of the S corporation. So, okay, Mike, I'm taking $10,000 a month in distributions. Payroll allocate, like how do I allocate this payroll? So, like I said, we are going to be teaching you the way that we have been taught at Ledgerly. There's tons of case study, tons of case law, tons of IRS things like up here in our picture here, what the IRS cares about, what the IRS considers, the week approaches, yada, yada, yada. We are simplifying it for you as the business owner. You have a million things on your plate. So we're going to provide you with the resource that we use. And it is the Payroll Matrix, made famous by Mark Kohler himself. Mark Kohler, CPA, attorney. He has a extensive network of tax advisors, tax attorneys, people that know this stuff. He teaches his Payroll Matrix. We use that for our clients. We are teaching that to you today. So when it comes to the payroll allocation, we take our distributions And then based on our distributions, we do a quarterly allocation. But what is that quarterly allocation? Well, if we look at our payroll matrix, we'll see that this matrix is based on an average of net income or draws. We use draws. So whatever you take out of the company, that's the piece that we're allocating a percentage, whether it's 100%, 50%, 40%, and so on. That. And the rule of thumb is as your payroll, meaning your distributions increase, your percentage of payroll decreases. So let's look at a case study here. Undo all this. We're going to zoom out and we have our quarterly timeline. So let's say in quarter one, someone came to us, one of our advisory clients. We said, we're going to use Gallant, our Highlights Magazine example. Gallant, he's our all-star advisory client. He does all the things the right way. He asks the right questions. He comes to us, Mike and Andrew. I took $30,000 of distributions in quarter one. Okay. So he took $30,000, quarter one, $30,000 of districts. Great. Let's look at our payroll matrix. So $30,000 is probably going to peg him right down here. Okay. So if we look at a percentage of his distributions, we're probably going to want to do half. Because his payroll, his distributions is low enough, we're probably going to want to do right in the middle here. So let's cut this in half. Let's call it a $15,000 payroll. $15,000 Q1 payroll. So on his 941, his quarterly payroll returns, he's going to do a 941 with his other employees as well. But if it's just himself, his 941 is going to be $15,000 of wages, and he's going to pay payroll tax on that 15. Rather than paying payroll tax on the entire 30 at the end of the year. Remember, S Corp, single member LLC, we're saving on the FICA here, so we're only paying on the W-2 piece of his distribution. Cool. So 30,000 distribution, 15K. Now, let's say in Q2, maybe it's a down quarter for Gallant. Let's say he only took 20,000 as a distribution. Okay, so year to date, he's taken 50,000. He's got 30,000, 20,000, 50. We're right here. We're right at this 50 mark. So what that would mean is our payroll, we'd want to be at about 25,000 for payroll. So we took 15 in quarter one. Let's do 10 in quarter two. 10K in quarter two. So we're at 25,000. Now let's say quarter three, Gallant comes to us. Mike and Andrew, I kicked some major you-know-what in quarter three. I took out 50,000 of distributions in quarter three. Heck yeah. So we took 50,000 out in Q1 and 2 combined. Now we took another 50,000 in one quarter. That's 100,000. That's going to peg our good friend Gallant at 100,000 of draws so far. So we would want our payroll to be at this 40,000 level. Now, we know our payroll right now is at 25,000. Between Q1 and Q2 is at 25. Now we want to get to 40,000. So 40,000 minus 25,000, he's going to do 15,000 of payroll here. And let's say in Q4, same thing. He's kicking butt. It's Christmas time. He wants to be giving for his family. He takes another $50,000 distribution. That means he's at 150,000 of distributions for the year. So that's going to peg him here. He's basically halfway between 40 and 70. So let's call it 55, which means he's going to take another payroll on his quarterly 941 of 15,000. So we're not doing tax strategy today, folks, but this is where the math breaks down. He took 150,000 out during the year. 55K is going to be on the W-2. 95K is technically K1. Only the 55K pays the 15% self-employment tax, the FICA, the double FICA. The 95K avoids it. Now, it's another topic in its own, but we need to be mindful of it. Let's say Gallant wants to max out, let's say he's a solo 401k. He wants to max out his solo 401k. Let's say he wants to do the 70,000. If he's only taken a $55,000 W-2, he can only do the $55,000 in the solo 401k. So there's a sweet spot there. Do we want to minimize our FICA? But if we minimize our FICA, we're limited what we can do for our 401k or solo 401k. Or if we want to do the mega solo 401k, the mega backdoor, we need to make sure our salary is high enough, which means more FICA. So there's a happy median here. So there's a push-pull relationship between the two. However, when it comes to reasonable comp is the topic of discussion here. The IRS cares about the money you take out of the business. So when we go back, we look at an 1120S. The IRS is looking at line 7, compensation to officers, which is you, the shareholder, and line 7 on the M1. the M2, distributions. They're going to add both of those numbers up and make sure they are in line with the payroll matrix. So if we're reporting 95,000 of distributions here and 55,000 here for wages, we're going to be good. We're going to be in the green. But if we showed $10,000 of salaries and wages here, but for Goofus, and 140,000 of distributions here, well, Goofus has got to get audited. So taking a major step back here, you're an S Corporation owner. We're going to wrap this up, bring it on home. S Corporation owner, I don't care about how many employees you have. I care about you for the sake of reasonable compensation. You're an S Corporation owner. You're going to continue to pay yourself by distributions. Every quarter, we take those distributions and we do an allocation based on the payroll matrix down here. However, if you're still unsure, you have other comments, questions, concerns about this mega topic in the industry with S Corporation owners like yourself of reasonable compensation, that's why we're here to help you. We've learned from the best in the industry. Shout out Mark Kohler and his tax advisory network. We continue to learn from them. We continue to teach our clients these strategies, such as reasonable compensation. But if there's any comments, questions, concerns, you name it, that you want to piggyback with the reasonable compensation, make sure you hit that subscribe button and stay tuned for more videos like this one. And let's get a call on the books. Let's help you minimize the FICA, keep that hard-earned money in your pocket, and let's end quarter one the right way and set that foundation for quarter two and the rest of the quarters for you to use this payroll matrix with ease and be able to tell your friends and their family about it so you can focus on your business and less time worrying about reasonable compensation. We'll see you on the next video, everyone.